Good day, friends. We continue our financial education in the field of crypto derivatives. Today we have lesson number 10, which is dedicated to the popular option strategy, Straddle. I suggest we build one strategy on the central strike. First, we will look at the bot Straddle. To do this, let's buy, for example, 1000 options, 1 Bitcoin, of strike 31. Let's buy 1000 call and put options. We get the strategy called Straddle. The name of the strategy is easy to remember. Double D stands for double buy or double sell of options with the same strike. This strategy can be built differently because we know how synthetics work, and with this knowledge we can build other strategies. In this case, we have a buying, tending strategy. Notice the delta is rising. I hope you remember what delta is. See, as the prices of the basic futures asset rises, the delta increases. As the price falls, delta decreases, tending to negative values. This strategy could have been a volatility buy if we had added a delta hedge. But that's not the point now, even if Straddle is often used in such strategies. Here we are expecting some strong price movement to occur. In this strategy, the no-loss point is at 32,250. If there's a fall, the no-loss point is at 28,700. There are 2.5 weeks until expiration. If the price stays in the range between these no-loss points, the time decay will bring us a loss in this strategy. We will incur the maximum loss at the strike point of the purchased options. Here the vega is maximal, time decay is maximal, theta is maximal. For us to make money, one of two scenarios must happen, either a rise or a fall, and preferably a rise in volatility. If there is no crossing the range during the period of time before the expiration, this strategy will bring us losses. In a bot straddle, the margin requirements are equal to the premium. I suggest we move on to selling, because buying straddle is frankly an unpopular strategy. It works only when delta hedging is used and it turns into pure volatility buying. But I'll talk about that in future lessons. To get a sold straddle, you need to sell call options, sell put options, and you're done. First, quick note. We already know that it is not necessary to sell call and put options. Through synthetics, you can sell only call options and open a position in the futures. It is necessary to sell twice as many call options, 2000 instead of 1. In order to get a synthetic sold put, you need to sell the call option and buy the futures. So let's say I buy 1000 futures now. Done. We have 2000 call options sold, 1000 futures bought, and we got exactly the same straddle as if we had sold put and call options. This is a counter trend strategy, meaning that when the price rises, we get a rising negative delta. The strategy is gamma negative. Theta is positive. Time decay works to our advantage. Daily cash flow. And the strategy's vega is negative, which means as volatility rises, we take a loss. No loss points are the same, but mirrored. In order to make a profit, we need the price to be in the zone between the strikes before expiration. The maximum profit will be equal to 2300, but the maximum we can get if we guess, that's right, if we guess the central strike. The strategy can be rolled if there's a price movement. You don't have to deal with call and put options. You can roll synthetics as well. This strategy can bring from 5 to 10% profit at a time. On the scale of a year, it's possible to reach 50 and 100%. Such a strategy definitely requires risk limitation. In this case, if there's a significant growth or fall, it is necessary to turn on delta hedger or to neutralize the delta. This means that in case of a fall, you should sell futures, but in case of a rise, you should buy futures to neutralize the delta. It may happen that the price will come back, but remember, if you switch to delta hedging mode, it will be a different strategy, volatility selling. But in case of strong movements, I always advise you to be ready to neutralize the delta with futures or turn on the delta hedger. The delta hedger robot can be customized as you like, price conditions to trigger and so on. By the way, you don't have to use Straddle on a central strike. You can take any strike. Let's say the strike where you expect the price to come in. For example, I expect the price to rise to the 33,000 level. That means I sell 2,000 call options and I get a strategy like this. Straddle shifted to the level 33. You can use this strategy if you expect the Bitcoin price to rise. The delta does not necessarily turn out to be neutral, but you expect the price to rise and you will maximize your profit. Maximum profits on the delta and profits on the time decay, or I can implement delta neutralization and get a skewed straddle. So, if you liked the video, be sure to press that like button. Write in the comments your questions and suggestions for the next topics. Subscribe to the channel, where there's a lot of useful information about options. My recommendation: go to AE Terminal and try to build strategies and combinations by yourself. Try a purchase straddle with different strikes. And thank you for your attention. Goodbye.